Well, there are three kinds of asset classes: shares which pay dividends, property which pays rent, and fixed income which pays interest. We define any securities that pay interest as fixed income. A bond is a loan from an investor to the issuer of the security. There are many different types of bonds, including fixed rate, floating rate, amortising annuities, and inflation-linked bonds. Bonds can be issued as senior secured debt, senior unsecured debt, and subordinated debt. These are simply categories that relate to the rankings of these securities in the issuer's capital structure. For example, subordinated debt ranks below senior debt, and therefore an investor would expect to receive a higher rate of return from these types of securities. The vast majority of bonds are issued for a fixed term, usually 3+ years, and have a legal final maturity date on which the investor is repaid his capital by the issuer. Throughout the life of the bond, the investor receives a regular, usually quarterly or semi-annually, interest or coupon payment. Term deposits are non-tradable, fixed interest investments offered by a financial institution with maturities ranging from 1 month to 5 years. A typical term deposit will pay interest on the investment amount on the maturity date. If required, FIIG can negotiate alternative term deposit structures on behalf of the investor. There are also negotiable certificates of deposit. These are shorter dated investments, usually 1 to 12 months, issued and guaranteed by a financial institution to meet their required funding needs. These are usually only available in larger amounts, in excess of $100,000. Finally, there are at-call accounts. These are just normal bank accounts where funds are available to be called or withdrawn by investors at any time. Hybrids are a broad classification of deeply subordinated securities that have both equity and debt characteristics. They are issued by companies and financial institutions alike to raise capital for particular requirements. Hybrids pay a predetermined fixed or floating rate of return until a certain date. At the end date of the investment, the issuer of the hybrid has the option to either repay the investor in cash or by converting the securities into the underlying shares of the issuer. Hybrids therefore are more closely correlated to equities than they are to bonds. So in summary, there are three types of fixed income investments that we focus on: bonds, deposits, and hybrid securities.